Good afternoon. I want to share my thoughts on why company reporting goes wrong and how to fix it. I'm going to look at the structure of listed companies where there are fundamental conflicts of interest, and I don't think these get talked about enough, perhaps because people are too polite. Then I want to focus a bit more on auditing. All my career as a tax advisor, I worried about being sued, and that's why I never speak without a disclaimer slide. Realistically, nothing I'm going to say today could ever be taken as advice, but the key message on this slide is that nothing I say should be taken as the views of AXA. I'm speaking only for myself. I spent over 20 years helping to audit listed companies, despite being a tax partner. And the reason is that tax is too complicated for audit partners. And my audit partners needed me to assess whether the company's tax provision was reasonable. But unlike many auditors, I've also been on the client side of the table. 5 years on the board of Manchester Training and Enterprise Council taught me something. Non-executive directors need internal audit to know what's really happening inside their company in detail. And they need to protect and listen to the head of internal audit. Serving on the Council of Salford University helped me to understand why corporate governance fails so easily. Fundamentally, most people want to be liked. However, an effective non-executive director needs to say things that people don't want to be said, and he or she needs to risk being disliked. Many people forget that firms like PwC, because they're limited liability partnerships, have to publish audited accounts. And as a member of the PwC Supervisory Board, I had a very peculiar role. On the one hand, I was a partner in the firm. But on the other hand, the Supervisory Board role was just like being a non-executive director of the firm. Now, I write regularly about finance and corporate governance, and I want to recommend a piece in the finance menu on my website. It's called Corporate Governance: Why It Is Needed and Why It Fails So Often. It's a talk I gave to teenagers at a school in Southport, and I used Bruce Wayne, better known as Batman, to explain corporate governance. And if you want to know the connection, you need to read the article. Here we have a listed company, and there are agency problems all over the place. The shareholders own the company. They're not allowed to run it. They're not capable of running it. They don't even have the legal right to insist on being able to walk through the front door and look around. The shareholders do elect the non-executive directors, but who gets to be nominated as a candidate? Good practice now requires a nominations committee independent of management, but does senior management get to have a voice behind the scenes? I remember at my university role where we were looking for a new chair of governors because the old one was going to retire, and the Vice-Chancellor offered to help in that process until I reminded him about the concept of regulatory capture and how personally I didn't want him to get involved in the slightest in the recruitment of a new chair of governors. And he then did stay out of the process as far as I'm aware. The shareholders also elect the executive directors, but they rely upon the non-executive directors to nominate them. On the other side of this diagram, we've got the auditor. The shareholders elect the auditor, but from a choice of one candidate. Who chooses the candidate? Good practice now says that it's only the non-executive directors who select the candidate, because the audit committee is entirely non-executive directors. But who really decides? And how much of a voice does senior management get inside the closed room? Suppose the CFO says to the audit committee that he cannot stand a particular firm. Will the audit committee still go ahead and select it? Once the audit firm is selected, will it keep the job if management says that the auditors are being awkward and the auditors are hard to work with? I've read lots of audit proposal documents written by PwC because I was helping to write them. I've also read audit proposal documents from other firms, and they all stress how easily the firm will work with management. They stress how little nuisance the audit firm will create. I've never read an audit proposal which said, "We will make you stick to accounting standards as we, the auditors, interpret them. We will not let you do anything to smooth the results. We will demand to see proof of everything that you tell us. We know that your objective as management is to manipulate the results, and we're not going to let you do it." Obviously, I'm being facetious. But the proposal document could make exactly the same points in polite language. Tell me later if you've seen one that did. All audit partners know the law about auditing and their legal responsibilities. Despite that, my experience is that in practice, they almost always see the CFO and the CEO as the client. And the reason is that in practice, top management are the people who can get the auditor fired. If you upset the CFO and the CEO, you're not likely to stay on as auditor. And as long as shareholders let management fire auditors, shareholders will continue to get bad auditing. I think it's a miracle that despite these conflicts of interest that I've been talking about, most audits actually are done well with high standards of integrity. And the reason is that auditors have real serious professional standards that they want to stick to. And an even bigger reason is that auditors are, quite rightly, scared of being sued. Now, people are always fighting the last war. A long time ago, non-audit work for audit clients was a real problem. Audits were often seen as a lost leader. Win the audit and we can sell them lots of other work. That attitude of mind obviously isn't conducive to tough auditing. And the perfect example was Enron. Agree to any accounting that the client wants in order to keep the client. In reality, changes in market practice and changes in the rules have basically eliminated this problem. Now, being the auditor makes it much harder, not easier, to sell other work to the company. We should finish the job. Ban the auditor from doing any non-audit work. The only exception is work which is clearly audit related in some way, and that work should be reserved entirely for the auditor. The more fundamental problem is the one I mentioned earlier, the auditor thinking of management as the client. And I believe that solving the auditor independence problem requires much more drastic action than is currently planned. I would take the power to appoint the auditor entirely away from the company. Give it to a regulator who's got no connection with the company, let alone connection with management. And this will finally kill off in the minds of auditors that management is the client. It will mean that auditors can be as bolshy as they want to be with management, because management will have zero power to get rid of the auditor. And that's all I wanted to say, and we've got plenty of time for discussion.